Inflation is not an act of God, it's a policy. That's derived from a quote from a well-known Austrian economist and something that's echoed by my guest on GoldCore TV this week, Tim Price of Price Value Partners and author of Investing Through the Looking Glass. Tim believes that the current inflationary pressures that we are seeing are only the beginning and could be part of a transition to a new monetary system. Watch this video to learn more. And remember, if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to GoldCore TV and hit the notification bell now. Tim Price, welcome to GoldCore TV.
Thanks for having me on the show, Dave.
It's great to have you. Now, I've heard you quote Ludwig von Mises recently, and the quote's in relation to inflation. And this is the full quote. The most important thing to remember is that inflation is not an act of God, that inflation is not a catastrophe of the elements or a disease that comes like the plague. Inflation is a policy. Now, we're seeing in the UK, where you are, inflation at 6.2%. In the EU, where I am, 7.5%. In the US, we've got inflation knocking on the door of 8%. And we're even starting to see inflation in Japan for the first time, or at least the threat of it. And in certain places around the world, like Turkey, it's an awful lot higher. And we're seeing inflation at 60%. Inflation is a policy. What are they trying to achieve?
So the way I tend to look at this, my background is in the bond market. So I started out, for the first 10 years of my career, I was a bond salesman working for Japanese banks and American banks and French banks and whatnot. And my contention would be that most people working in finance don't really understand money, which sounds like a bold statement, but I think I can defend it.
Yes.
And the problem is that people tend, so in terms of firstly sort of lambasting the city and Wall Street, I think the reason that is the case is that Wall Street tends to put people into silos. So, for example, from the bond perspective, you start out, I was always a generalist bond salesman, so I was perfectly happy to sell anything as long as it had perceived value to my clients. But let's say if you were a trader, you'd start out as maybe a generalist trader, and then you'd become a bunt trader. You'd trade German government paper, and then you'd end up in this absurdly narrow silo whereby you'd be trading 2 to 3 year obols, which is a tiny little subset of the German market. And you're thinking, why on earth would you want to do that? So the city is very good at forcing people into narrower and narrow disciplines. And I think what that means is that you don't actually see the bigger picture anymore. So anyway, so my contention is that a lot of people working in finance don't really understand finance. And they certainly don't understand the money creation. There is a book that I was given by a gentleman, Tony Deeden of Edelweiss Holdings in Zurich, many years ago now, probably getting on for 15 years ago. And it's called The Ethics of Money Production by a gentleman called Jörg Guido Hulsmann, who teaches this stuff. He's a professor in France. Money production is an extraordinary and magical process that I think most people, including bankers, don't really understand. But to get back to the inflation perspective, what is this all about? What is driving this? My contention has long been, our contention as a business has long been that there is too much debt in the world. This has taken place over decades. The rot set in the early 70s when Nixon took the dollar off gold. So at a stroke, severing any connections to commodity reserves, commodity backing for a fiat currency. And what that ushered in was a period basically of uncontrolled credit expansion. If your capacity to print money is not limited by anything tangible, you'll print money till the cows come home.
There's no discipline there. There's
no discipline whatsoever.
Needed.
It's like a ship bobbing about in the harbor. It's completely unmoored and anchored to anything. And I think what we're literally living through now, and I'm trying not to be deliberately contentious, what I think what we're undoubtedly living through now is basically the last days of the fiat currency system, the global fiat currency system, or perhaps the last days of the petrodollar. So if you accept the thesis that there's too much debt in the world, particularly government debt, but also corporate and household debt, mortgage debt as well, then there are only 3 ways of tackling that problem. The first is that governments try and engineer enough economic growth to keep the debt serviced. I'd say after 2 years of absurd COVID fighting, that's now not a realistic option anymore. But so that we won't get the growth. The second option is that depending on how polite you want to be, you either deflate it, you either default on it, or if you want to be more polite, you say you'll have a restructuring or some kind of debt jubilee. But the bottom line is you default on it. So debt holders are left holding the baby. And since we operate in a credit-based monetary system, that's Armageddon. So let's park that one as an option. So what is in box number 3? What is in box number 3 has been the strategy to which all heavily indebted governments throughout all of recorded history have resorted, which is you inflate it away. And I think that's literally what's happening now.
And the rationale behind that is it's the easiest thing to do.
It's the easiest thing to do, and as I think as Keynes said, you affect a monetary debauchery, but it's so subtle that not one man in a million can understand what's going on. So it's like a theft in plain sight.
Yes.
So
you're seeing that across the board now.
It's a global phenomenon. So I mean, you've highlighted Turkey as one of the more sobering
outliers,
victims, but we all get there in the end. So what is with the phrase? Sooner or later, everyone sits down to a banquet of consequences. We are paying now. We are all, as individuals, having to operate in this fiat system. We are all paying the price for decades of monetary debauchery, and those chickens are coming home to roost now.
And why do you believe that it has come on so quickly? And what I mean by that is we've had low inflation for a long period of time.
I mean, I'm not sure I trust the inflation figures to begin
with.
Well,
that's
true.
Question. That's
so
true.
Whether the CPI print is 5 or 10 or 15% is, we could sort of debate. It's like arguing about how many angels could dance on the head of a pin. But the bottom line is we all know that inflation is going up because we know and this is the crucial thing, which takes us back to our friend Ludwig von Mises. We know the inflation's there because, and this is a crucial fact that I can't emphasize strongly enough. Inflation is not strictly the higher prices of goods and services. That's a second order effect. The core inflation is the amount of base money that's been printed in the first place. Yes. And then the fact that price of things tend to rise is a second order impact.
Yes.
But the inflation is the increase in the money supply. So if you increase the money supply massively, and at the same time as you're actually having an economic correction, a contraction through, again, ridiculous counter COVID measures, no surprise that more money chasing fewer goods leads to higher prices.
Mm. So you're having that opposite effect.
So I think we're seeing this as an international phenomenon. Mm-hmm. And then you add all these other absurdities like the supply chain constraints that have come with, again, counter COVID measures plus what's happening in the Ukraine. It's beginning to feel a little bit like all of this has been designed. This no longer feels like accident anymore. But that sounds sort of conspiratorial. But the bottom line is, as far as the inflation, the price impact is concerned, particularly in relation to things like precious metals, agricultural foodstuffs, commodities generally, this is all a function of more money having been printed for the last 40, 50 years. So your question was, why is it happening now? I'm just surprised it hasn't happened sooner, to be honest. But maybe that's a function of the fact that what was the original trend was globalization, the entry of China onto the global market. And so you had that entry of China into the international trading community was a seismic, massive one-off deflationary shock. But that's run its course now, because now it feels like the world is going into the opposite of globalization. We're going into a deglobalized world. We're going into a reshoring world. And in a reshoring, deglobalized world, prices are going to be sticky and they're going to be higher for longer.
So we had a lot of events that kind of absorbed that monetary inflation for a long period of time, and now there's a confluence of factors and a confluence of events that's doing the opposite.
Exactly right. So the tree doesn't grow to the sky.
Yeah.
And I think people are missing a trick here when they talk, because I'm trying to sort of allude to a sort of grand historical sweep, but the current interest rate cycle began effectively with a gentleman by the name of Paul Volcker at the Federal Reserve in the early 80s. And back then, US inflation was double digits. It was high teens, as was the yield on the long bond. Volcker was parachuted into the Fed, very unpopular. He broke the back of inflation, but he got death threats and all kinds of popular protest. But he broke the back of inflation, and in the process of doing so, basically engineered what we can now say with the benefit of hindsight was a 40-year bull run in interest rates and in bonds and in stocks. So it was happy days. Everything worked until it stopped working. And we've now reached basically the zero lower bound, so-called, the fact that you can't realistically put policy rates much below zero, if at all. And as a result, that 40-year bull run, I would humbly submit, has run into the sand now. That doesn't mean that bond yields are going to go shooting higher, probably because central banks will do everything in their power to control them. But if you expect that the central banks will then try and suppress bond yields artificially through QE, through all the kind of monetary chicanery they've been doing for the last 20, 30, 40 years, my sense is that if you try and suppress bond yields, you force the trading community that is paid to have an opinion about prices to migrate to the one market that can't be kicked around, that's too big to be kicked around. That market is the foreign exchange market, which is too deep and too liquid for even the world's central banks combined to manipulate forever. And then perversely, all roads lead back to gold, because if you can't trust prices in bonds, you're querying prices in, and let's say the equity market in the short run because of price manipulation by central banks again, then the one price you think you can exert a free market opinion on is that of currency. And if the currencies start getting hit, which some of them already have been, if the currencies start getting hit one by one, ultimately you have to conclude as an investor, takes us back to Mises again, if the crack up boom, which is when everyone tries to convert their increasingly worthless paper into something tangible and physical, then gold is going to be a prime beneficiary of that, because gold is the one currency in the world that you can't print.
So let me just step through that then again. So you've got the bond market. If we see attempts to continue to control the yield curve on the bond market, what you're going to and keep them artificially low as opposed to where they actually need to be in order to tackle inflation.
Because I think what the market wants is a deflationary cleansing of the system. Liquidate labor, liquidate capital, liquidate like the 1930s, liquidate everything. But obviously that's not politically palatable. So instead, we get more money printing.
So we'll see a migration, as you say, to express that discontent in the currency market and sell down the dollar. But the problem is that they'll be selling down the euro at the same time, and all the major currencies.
So effectively, I mean, Keynes coined this concept, brilliant concept known as the sort of the Keynesian beauty contest, whereby capital allocators, traders, fund managers are not voting who they think is the prettiest girl, but who they think everybody else thinks is the prettiest girl.
Yeah,
which is a fantastic metaphor.
Yeah,
and that's basically the capital markets.
Yeah, and it kind of goes from there to when we get into the currency markets, and we've got printing going on all around the place. It's let's vote for the least ugly one.
Well, I think it was Satyajit Das that described the current currency system that we have as, or the currency world that we inhabit is the abstraction of an abstraction. At one point, you had physical bullion and silver backing money, and then now we don't even have that. So they became promissory notes. They became paper promises. Now we don't even have the paper. Now it's just digital. Now it's just blips on a screen. It's so far removed, so far divorced from any kind of tangible backing. And we know that, I don't know what the figures are, it's probably only 2 or 3% of the money in circulation is actually in physical cash. Everything else is digital. So we've come so far down this road of intangibility already. But to go back to that earlier point, my dread is that we are in the early stages of the Misesian crack-up boom, which is this trend towards people trying to convert their increasingly worthless paper into something that will retain some form of store of value, which clearly the fiat system can't do anymore. And to add insult to injury, the other thing that's accelerated this trend lately is the fact that through his geopolitical matters in the Ukraine, the US effectively has arbitrarily gone after Russian assets. I was shocked to hear this, because I consider myself a reasonably sort of fluent with financial history. I wasn't aware that even at the height of the Second World War, the Bank for International Settlements, the BIS, which is the central bank's central bank, kept and honored basically property rights for the Nazis. So even in the Second World War, the BIS didn't go after Nazi gold. But mysteriously, of late, the US authorities have basically deemed it completely appropriate to seize Russian reserves and basically invalidate them.
It's a black swan event, really.
It's a complete black swan event. So what that means is that Russia's basically been forced into a bit of a corner. But I think I treat this as almost like a what's the phrase in tennis? An unforced error. My preferred metaphor for describing US sanctions policy is now like a clown running over a minefield. because they're trying to exert all these influences and sanctions and whatnot, but they're making themselves look completely foolish in the process.
Yes.
Because all they've effectively done is force Russia of necessity into an even closer relationship with China, probably India, secure basically alternative, currency flows for Russia that are not part of the dollar system anymore. They've shot themselves in the foot here.
And also,
so the one thing that's really, sorry, just to finish to the point, the one thing that's really changed in my worldview over the last just 2 or 3 months is I used to think that the US dollar would be the last man standing. There's the least dirty shirt.
Yes.
And now I'm just not so sure anymore, because if the US is willing to inflict so much self-inflicted pain on its own currency and its own trading relations, what else is it capable of doing by mistake?
Yeah. And the unintended consequences, I'm going to say, there's whatever they've done against Russia, you've got other central banks and other governments around the world who are large holders of US denominated assets.
For sure.
And they're looking at it going, what if I'm next?
Well, exactly. Everybody, not just at a central bank level, but even at an individual level. I mean, you had the same thing with Canadian truckers.
Yes.
That people were giving money to what they thought was simply an honest, worthy cause, truckers against tyranny in the case of sort of Trudeau's Canada. And then people who innocently gave money to a campaign suddenly found their bank accounts have been frozen. What the F is going on? So if the authorities are willing to sort of jump in with their size 12 boots in such a draconian way, then you think, well, then that gives any sentient person real cause for concern about where does this encroachment on property rights end?
Where does it end? That is the question. So let's just again step this forward. Where do we go next?
I mean, have you got a spare couple of days? Who knows? But all I can. So what's our day job here is not to opine weightily on matters geopolitical. Our day job is to try and protect the money that our clients have given us.
Yes.
So we manage money for private clients, and we do so in 3 ways. The 3 asset class, we spoke about this before we went on air. The 3 asset classes that are our natural preference now. Bonds used to feature; they don't anymore because bonds have no value. They are just return-free risk. So the 3 asset classes that we feel make sense in this environment: value stocks, a la Benjamin Graham. So decent quality companies run by decent, shareholder-friendly executives, a good board, hopefully, hugely cash generative with little or no debt. So that's in the first box.
What type of stock would fall into that? Just so
it'll be bottom up. So it'll just be whatever's got a great cash flow yield. It could be in any sector.
Right.
But because we're sort of inclined primarily to sort of safety first, we'll stick fairly close to the shore. So it's unlikely that they're going to be tech stocks right now. It's unlikely they're going to be Amazon or Google or Facebook, but they might well be, a pork producer or a car parts producer or whatever. So value stocks is the first port of call for us. The second port of call is a completely uncorrelated form of trading vehicle called a systematic trend following fund. Simply a price momentum approach. Buy what's going up, sell what's going down. That in essence is a trend following fund. They're hugely diversified by sector, by underlying investment, so they've got no correlation to the stock or bond markets at all.
Well, they follow up trends when the trends.
They follow up trends,
down,
exactly. They follow down exactly
down.
right. So at any one time they may have no exposure to the stock market, or it may be negative. They may be short.
Sure,
but that's a useful diversifier for us. And then the third component part is effectively a reiteration of the value approach, but in the form of the commodities space. So what we call real assets, but predominantly real assets, listed businesses, again with the same qualities, good management, cheap, high cash flow generation, little or no debt on the balance sheet, but that derive their earnings from the commodities markets, whether that's coal, iron, zinc, copper, gold, silver, whatever's profitable. And so a combination of those 3, plus or minus, is how we think we can best protect our clients' assets in an environment where there are no safe havens anymore.
And the crack up boom, do you see that happening? We've had some commentators saying that while we've seen a sell-off in equities, there is still potential for a new all-time high, significantly above where we are, when people literally want to exchange their fiat currency for anything. Do you see that potential, or do you see that potential only in certain sectors? So you're saying now in technology, we're not going to see an all-time high
mean,
again in technology.
we're value guys, so we're unashamedly sort of value biased. The last year has been the first year in which quote value unquote has outperformed quote growth unquote in about a decade. So we've been fighting some horrendous headwinds for a good 10 years now, but that pendulum feels like it's started to swing back. And it'll be for two reasons. Firstly, because the value stuff's outrageously cheap. And secondly, because a lot of the growthy stuff is outrageously expensive. And this is where I think that the sort of the tyranny of indices comes in. So I was having a look earlier at the composition of the MSCI World Equity Index. Now, the MSCI World Equity Index is the index that matters to you if you're managing money on a global basis for international clients. And it's a market cap weighted index of basically the largest countries, the largest sectors, and so on and so forth. But the point I'm making is 69% of the MSCI World Equity Index is the US. So if you're a global manager benchmarked against that index, you have to have 2/3 of your money in the US, whether you even like the US market or not, which makes no sense whatsoever. So one thing that we've always been quite adamant about is we don't mind having a benchmark or a reference rate, but we're damned if we're going to use a market reference rate, because it doesn't make sense to go down when the market goes down. You can't take relative negative returns to the bank.
And so on the value stocks, you're very much looking at commodity producers.
I mean, whatever works, but the cheapness, the attractiveness of the commodity sector relative to paper assets per se. One of the ratios we've started looking at recently is I think it's the constant commodities index versus the S&P 500. On that basis, the commodities market hasn't, bizarrely, given what's happened in commodities prices over the last 12 months, the commodities market, notwithstanding the recent rally, commodities have not been this cheap relative to listed assets, at least in the US, for 60 years. Wow. Now, this is quite incredible, because you would think that just at a time, if you believe this thesis about the crack up boom and so on and so forth, and certainly, I don't know about you, but certainly a lot of the people we speak to are increasingly concerned about the threat of inflation, as much realized as hypothetical, because it's already here, of course, but it could yet get worse. Then it doesn't make any sense that the one particular area of the market that can offer you protection against that is being given away by the stock market. That is quite absurd, and yet it's there. Now, our job isn't to rationalize why it's so absurd. Our role is simply to scoop up all that free money.
Yes, and I think one of the reasons that people have possibly been slow to react is, we've got a generation of people nearly that have not experienced inflation. We've had low inflation for so long that I know you
don't believe it could ever exist.
Yeah, and
it's a bit like when Bernanke said, "Well, we've never had a nationwide property decline in the US," even as a nationwide property decline was taking place.
Yeah. So there's an expectation that maybe this is only short-lived, and
but also anyone that's invested in commodities over the last 10 years has had a grinding bear market for part of that period, not that long ago. So everyone, it's like, there's this idea, I think it was Einstein said, a cat that sits on a hot grill won't sit on a hot grill again, but it won't sit on a cold grill either.
Yeah,
everyone's burnt by their recent misfortunes.
So what's the conclusion of this? I mean, ultimately, we're talking about the collapse of our current monetary system.
Yeah, really. And this is I was talking about my
I know that's probably sounds like a bit of a bit.
No,
of a
it
leap,
did. I don't think so at all. So I was mentioning my colleague Killian Connolly earlier. So Killian's actually studied, for want of a better phrase, monetary regime change at the LSE here in London. And and I haven't done the course, but I think to what I understand of it, from hearing it via him, is monetary regimes change all the time. And a typical monetary regime will last for maybe somewhere between 20 and 30 years. Mm-hmm. Now, the current sort of post-Bretton Woods regime has been in place for 50 years. So we are already overdue some form of monetary reset. So this isn't again, to go back to the sort of Mises quote, this isn't necessarily a catastrophe. It's just part of the natural order of things. Mm. But if you're a politician and a central banker and you're given the facility to print money without limit, you're gonna abuse that power. It's just it's inevitable. It's human nature.
I suppose as well, when we haven't seen one for 50 years, we haven't got that many people who have experienced it.
For sure. I mean, this is a regime step change that no one's really seen before,
or anybody's been at the helm of one of these
sure.
to usher it through or to manage it.
But if we bring back in our friends sort of Russia and the Ukraine, what does seem to have happened is that the US has handed Russia on a plate the prospect of A, destabilizing the dollar to a certain extent, and B, ushering in, for want of a better phrase, a gold-backed ruble.
Or even just a broader commodity-backed.
Or a broader commodity-backed currency. But either way,
which they're very close to having achieved at this stage, nearly.
I think that's the case. So you look at this from Russia's perspective, and clearly, I'm not defending Putin. I'm not defending war in any form. I'm simply pointing out that, again, we're in the realm of
it's the unintended consequence.
The unintended consequences. So in trying to bash Russia with the sort of the stick of the almighty dollar, they've actually, you wonder whether the US has created the mother of all unintended consequences, which is monetary regime change. It has accelerated that process. So what was probably going to happen anyway is happening at a much faster rate now.
And it's effectively it's handing over that power, then, that monetary power, to commodity producers.
But none of what's happening in Europe, or what's happened in Europe over the last 10 plus years, makes any sense, because you look at a market like Germany, an economy like Germany, which is the most important economy in Europe. They've turned off all their nuclear power stations. They're entirely dependent on Russian energy. And now mysteriously they're supposed to say, you know what, we'll decide to freeze for a bit, and let's turn our showers off, let's stop driving cars. I mean, the kind of nonsense cascading out of politicians' mouths now is really beyond the pale.
Yeah. So there's going to be a transfer of, if this comes to pass, which there is good argument to say that it will, there's going to be a global transfer of power to commodity producing countries.
That seems a plausible thesis, and
away from commodity dependent countries.
Correct. So this was something that was in train anyway. One of the bigger sort of secular shifts that we've been looking to try and benefit from for the last 5+ years is basically a swing towards Asia. So if you look at there's someone sent us basically a heat map, if you like. There's a global map of effectively the anticipated population of the middle class as defined by the OECD. So it's not probably what you or I would define as middle class, but what the OECD defines as middle class relative to sort of like minimum wage and that kind of stuff. And the bottom line is that the US middle class population is not forecast to grow much, but you wouldn't expect it to, because it's a mature economy. It's been a mature economy for years. Europe is not expected to grow its middle class either. I'd go further and say I think Europe's probably already in recession, if not a depression. But the one area of the world that is forecast to see an absolute boom in its middle class is Asia, and that's not just China. It's China, India, the Pacific Rim, all of that area. And if it comes to pass along the lines the OECD has forecast, it'll be the greatest creation of wealth in human history. So if you're looking for sort of like big trends, then hitching a ride on Asian outperformance in stock market terms relative to the US ? UK ? Europe ? Seems like an interesting development. So then that was already the case long before COVID came along, but COVID may yet sort of accelerate that trend. So from our perspective as managers, that's not to say we make these sort of sweeping macro calls and then invest accordingly. Everything is driven by the bottom-up valuations of what we buy. But if we have a combination of attractive bottom-up valuations at a stock level, plus big, plausible, quite convincing, big picture themes, if we see them both, then that's going to be exciting to us.
And in terms of time frame of this transitioning away from transitioning in monetary system, we're at the very early stages of that. Would you agree?
Yeah, absolutely.
Is this something that unfolds over a year, 5 years, 10 years?
I don't know what the sort of historical thing has been, but I'm tempted to sort of echo or channel my inner Hemingway when someone said in one of his books, I think it's The Sun Also Sets.
Yes.
When someone said, "How did you go bankrupt?" He goes, "Slowly and then all at once."
Yes.
So that's the way things happen in financial markets. When you get a regime change,
as we were discussing earlier,
and then it just happens overnight.
Yeah, as we were discussing earlier with inflation, that sudden onset of inflation and the potential for this monetary regime change.
Because in financial markets, prices don't rise in a straight line. They, you have the early adopters and the later adopters, and then the shoe shine boys, and then it goes bang.
So you'd recommend now that people start planning for this in terms of the allocation in their portfolios?
Well, let's just say we already are. So, assuming that we're doing the right thing, which I hope we are, then it would make sense, yes, to let's say to spend more time thinking about inflation protection than you've historically needed to, because it hasn't really been an issue hitherto.
Yeah, all evidence suggests that we are going in that direction.
I mean, the thing that in my career was probably the seminal event was really at the start of it. So in September 92, it was living through the sterling ERM crisis, when sterling was ethnically cleansed from the exchange rate mechanism. And what I learned from that was, firstly, never to trust politicians, and secondly, never to trust anything until it's been officially denied. So when you had all these politicians queuing up to say, "Oh no, we're definitely going to be, we're sticking to this one, we're definitely committed," we just knew the thing was doomed from the get-go.
So we're based on what you're saying, is it's utter destruction of fiat currency as we know it, to be replaced.
Well, let's just say it's a meaningful potential monetary regime change in ways that are not easily forecastable, but could plausibly include commodity backing for some of the bigger players.
Okay, which naturally would suggest then we're only at the very early stages of a commodities bull run.
And this isn't necessarily something to be afraid of. I mean, as a child of the Cold War, and I remember, hearing teachers at school saying, "Well, if the balloon goes up, I'm going to drive to Birmingham International Airport because that'll be the first place to get nuked, and I'll get it over and done with straight away." And need to say, I had a cheery childhood. But back then it was a bipolar world between the US and the USSR. Now it's looking increasingly like a multipolar world, where you've got the US as a declining power, realistically, China as the ascending power, Russia as question mark how you define Russia, Japan, the Asian economies, Latin America, even Africa. There's a lot more going on now, and the fog of war kind of sits over everything right now. But so it's not necessarily easy to see who the obvious winners and losers are going to be. But I think actually a multipolar world may actually be a better world as an investor, because as we've shown, when the sort of the big guy on campus starts throwing his weight around, that can go badly wrong for everybody, including the big guy on campus. Yeah.
So basically what you're saying is, change makes us all nervous.
But it's not necessarily something to be afraid of.
It's not necessarily something to be afraid of. And you'd agree then, obviously, naturally, bringing it back to gold and silver, in an environment and developments like what you're saying, you're going to see gold and silver perform well, because effectively they're measured in fiat currency, and you're seeing whether it's the utter destruction or a transition away from fiat currency to a more commodity bank.
Transition sounds like a softer, lighter touch way of describing the development. But part of this is perspective. So one of the questions we often get, especially at this sort of part of the cycle, is clients will say, or just interested parties will say, when are you going to take profits in gold? Or when are you going to take profits in silver? And particularly in relation to gold, it's the wrong question to answer, because the question should be, gold is priced in dollars, but we should be asking, what's the dollar worth?
Yes.
So there's a scientific definition, a very precise scientific definition of what a kilogram is, which is it is the mass of a given amount of material at a given laboratory at a given altitude at a given temperature north of Paris. Well, that's a kilogram. What's a dollar? And you can't just say it's a designated amount of silver, because that doesn't wash anymore.
Yes.
So we're looking through the wrong end of the telescope here. The question should be, what is the dollar worth? And since we know that ultimately the answer is going to be, it's going to be zero at a certain point, maybe not in our lifetimes, but at a certain point, then you should make preparations accordingly.
Tim, before we finish up here, where can people find out more about what it is that you do?
So our business is Price Value Partners. You can find a bit more about us, including a commentary that I and my colleagues put out weekly and monthly and quarterly, pricevaluepartners.com. I'm currently in the Twitter gulag, but I hope to be back on Twitter fairly soon. But I'm a complete tart, as you can probably tell. So whether it's Twitter or Getter, you can find me on social media. But the best place to start is the website, pricevaluepartners.com.
Perfect. Well, what I'm going to do is I'm going to put a link to your website in the description below this video. I'll also stick a link to your social media profiles for when you get out of the Twitter gulag.
If I'm ever allowed out.
But Tim Price, thanks for joining us on GoldCore TV today.
My pleasure. Thanks for having me.
Thanks for watching. And if you enjoyed this interview, check out this video that I recorded with energy expert Steve St. Angelo. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.